Good day, fellow investors. Andre asks, can you share your opinion on high savings accounts yields? For example, Capital One, Sophie, Apple, they pay 4.5%, 5%, and using them as a short return on money, also insured 250,000. So the simple answer is the short-term yield is 5.5%, so any bank should give you 4 or 5% on your money. But we'll discuss that. We'll also compare it to stocks to give you an indication on whether you should park your money in something like that now or go look for other opportunities. But 5% is still 5%, not bad, with no risk. So I looked at NerdWallet, and many offer 4, 5% insured by the feds, etc. So nothing wrong, and that's completely normal on short term, because if you look at the US Treasuries market, lending money to the government, the yield there is for short term 5.5%, so you can give your money to the government for 6 months at 5.5%. Keep in mind here that as times go forward, the expectations are that yields will be lower, and therefore longer term people want to lock in these currently high yields. So this party is expected that it will be over soon. I would not bet on it, but that is what it is now priced in the market. So for 6 months, a year maybe, you can get the 5% we are talking here without risk. And that is because the Fed is pushing the effective rate to 5 now, but you can see in history that has a lot of ups and downs, and for the past 15 years we were predominantly at 0, and now we are at 5, which is nothing wrong historically, has been very often at such levels. 5% yield, inflation is 3%, so for now you still make 2% above inflation, even if real inflation will be higher. So that's nothing we can do about it, but for parking money, nothing wrong with such accounts. And we discussed also the market. The question is whether this is better than the long-term 4 to 5% by investing in the market. The key here, differentiating factor, is that this is short-term. 5%, if the yield next year is 2%, stocks will likely be higher because of their better alternatives long-term. Then you can park your money and see what to do with it later. But if yields persist, go to 7%, it is also possible, depending on inflation, then you can keep getting that money. But keep in mind that over the long term, you should invest in assets that also give you growth, that give you advantages over inflation. This doesn't give you an advantage over inflation, and therefore, if you invest just to protect yourself for inflation, $1 over 200 years would be 19, and that since the debasement to gold, so 80 years. But if you invest in stocks, you are at 13, 14 million from $1, and that is investing, and this is just, let's say, parking your money. So that is the decision you have to make. If we compare to the stock market, has done nothing in the last 2 years. It has been better to invest in bonds, etc., especially with the dividend yield just as low at 1.53%. And there can always be a crash of 50% that cannot happen with treasuries. So you have to see how this fits you personally. What are your financials at the moment? Even Warren Buffett has 164 billion parked in such 5% yielding treasuries, so that we discussed when we analyzed Berkshire just a while ago. So nothing wrong, to answer the question, if you don't have other better opportunities than just to staying afloat with inflation, nothing wrong with these short-term bank accounts or treasuries, especially if insured. even if the bank goes down, you will get your money from the government. Nothing wrong with that. Thanks for watching. If you're interested in more investing, learning about investing, subscribe to the channel and check my other videos and what I do.